5 investment scandals that shook the world. Money has always had a way of bringing out the best and worst in people. Some build honest businesses and create real value. Others cut corners, bend the rules, or break them entirely. In this series, we are going to look at 5 real stories of fraud and deception in the world of investing. These aren't just headlines. They're stories about people who got caught up in greed, ambition, and sometimes even good intentions gone wrong. From smooth-talking stockbrokers to flashy startups and billion-dollar trading firms, each one left a trail of damage behind. You'll hear about Jordan Belfort, the so-called Wolf of Wall Street, who ran wild in the 90s selling worthless stocks to unsuspecting investors. We'll talk about Nikola Motors, a company that pretended to have working tech just to impress investors and boost its stock. Then there's Robinhood, the trading app that claimed to help the everyday investor, but found itself in hot water during the GameStop frenzy. We'll also cover MF Global, where $1.6 billion in customer money vanished, and Archegos Capital, a behind-the-scenes player whose risky bets ended up costing big banks billions. These stories are different, but they all share one thing in common. People got hurt because someone chose profit over honesty. Story 1. The Wolf of Wall Street. Jordan Belfort and Stratton Oakmont. Jordan Belfort lived like a king. The mansions, the yachts, the private jets, the wild parties. It looked like he had it all. But behind the scenes, it was all built on lies. Big ones. This is the real story of Stratton Oakmont, a firm that became the face of one of Wall Street's most outrageous frauds, and the man who ran it like a circus, Jordan Belfort. Jordan Belfort was a guy from Queens, New York. He didn't grow up rich, but he was smart, smooth-talking, and knew how to sell. He started out selling meat and seafood door to door. That business failed, but it taught him something important. He could talk people into buying things they didn't really need. Later, he got into finance. In the late 1980s, he became a licensed stockbroker and started working at L.F. Rothschild, a respected firm. That didn't last. The firm collapsed after the 1987 market crash. Still, Jordan had seen enough to know there was serious money to be made, especially in penny stocks. In 1989, Belfort founded his own brokerage firm, Stratton Oakmont. He brought along a few friends, including Danny Porish, who became his business partner. The office wasn't on Wall Street, it was in Long Island, and it didn't feel like a finance firm. It felt like a frat house. Loud music, strippers, office drug use, wild parties when someone made a big sale. They hired young, aggressive salespeople, most of them with no finance background. They trained them to sell over the phone. The script was simple: win the customer's trust. Sell the dream, then get them to dump their life savings into penny stocks. Now here's the twist. Stratton Oakmont didn't just sell the stocks. They controlled them. They'd buy a bunch of cheap shares, drive the price up with hype, then sell their own shares at the peak. When the price crashed, the customers were left holding worthless stock. This is what's called a pump and dump scheme. The money rolled in fast. We're talking hundreds of millions of dollars, and Jordan Belfort lived like there was no tomorrow. A mansion in Long Island, a yacht that used to belong to Coco Chanel, luxury cars, private jets. The parties were non-stop. He married a model, Nadine Caridi. And their lifestyle? It was wild. Drugs were everywhere, especially Quaaludes. One time he crashed his helicopter into his own yard, another time he sank his yacht in the Mediterranean. Behind all the chaos, they were still scamming investors every single day. But eventually, the cracks started to show. The SEC and FINRA were watching. They started digging into Stratton Oakmont's shady deals. One big red flag? The 1993 IPO of Steve Madden's shoes. Stratton helped take the company public. But Jordan secretly owned a big chunk of it. That deal alone would come back to bite him. Even Steve Madden himself ended up doing jail time. Despite growing pressure, Jordan used lawyers and legal tricks to buy time. But it wasn't enough. The FBI launched a full investigation. They tapped phones, got employees to wear wires, flipped insiders. By 1996, it was over. Stratton Oakmont was shut down. Belfort was arrested. In 1999, he pleaded guilty to securities fraud and money laundering. He was sentenced to 4 years in federal prison, but served about 22 months. He was also ordered to pay back $110 million to investors. That debt is still hanging over him today. After prison, Belfort tried to turn a new leaf. He wrote a memoir called The Wolf of Wall Street. It became a huge movie in 2013, directed by Martin Scorsese, starring Leonardo DiCaprio. The film captured the wild energy, but some critics said it made fraud look too cool. Jordan went on to become a motivational speaker, talking about sales, success, and ironically, ethics. But for many of his victims, there was nothing motivational about it. They never saw their money again. So what can we learn from this story? It's not just about one guy and his crazy lifestyle. It's about how fast-talking confidence, high-pressure sales, and the promise of quick money can lead people into serious trouble, and how the people who lose the most are usually the ones who just wanted to build a better future. If this story surprised you, stick around. Let's talk about Nikola Motors, a startup that faked a truck demo to fool investors. Story 2. Nikola Motors, a startup that never started. They called it the truck of the future. Zero emissions, hydrogen-powered, quiet, powerful, revolutionary. There was just one problem. It couldn't move. Literally. This is the story of Nikola Motors. A billion-dollar startup that looked like it was changing the world until it all came crashing down. The man behind it? Trevor Milton. He was charismatic, confident, always pitching something big. In 2015, he launched Nikola Motors, a company that promised to revolutionize the trucking industry. Electric trucks weren't new. But Nikola claimed they were going a step further. They said they had hydrogen fuel cell trucks in the works, clean, powerful, and ready to roll. Investors loved it. The buzz was real. Trevor said all the right things on stage, in interviews, on social media. He promised everything from trucks to pickup vehicles to hydrogen stations across the country. In June 2020, Nikola went public through a reverse merger. It didn't take long. The company's value shot up to over $30 billion. Trevor Milton? He became a billionaire overnight. But something didn't feel right. There were no trucks on the road, no stations, no real proof the tech worked. Just a lot of hype, and one now infamous video. That video showed the Nikola One, the company's flagship semi-truck, driving through the desert. Except it wasn't driving, it was rolling downhill. No engine, no hydrogen system, just gravity. Nikola had to admit it. They towed the truck to the top of a hill, let it roll down, and filmed it to make it look like it was working. That was a huge red flag. Then came the short seller report. In September 2020, Hindenburg Research dropped a bombshell. They published a detailed report accusing Nikola of massive fraud. They said the company had been misleading investors for years, that Trevor had lied about almost everything. The tech, the prototypes, the deals, even the hydrogen production claims. They called it, quote, an intricate fraud built on dozens of lies. A few days later, the pressure got to Milton. He stepped down as executive chairman. The stock dropped fast. The Security and Exchange Commission and Department of Justice got involved. They launched investigations into securities fraud. In July 2021, Trevor Milton was indicted on multiple counts of fraud. Prosecutors said he lied to investors to pump up the stock price and enrich himself. As for Nikola, the company, they're still around, but their image took a huge hit. They distanced themselves from Milton. They paid $125 million to settle with the SEC. Their hydrogen truck, still in development, and nowhere near what they originally promised. In the end, it's another warning. Don't let big promises blind you. Sometimes the biggest stories on Wall Street are powered more by hope than by reality. And sometimes all it takes is a well-edited video to send a fake truck and billions of dollars straight downhill. Next up, we'll talk about Robinhood and how a sleek app for everyday investors found itself in the middle of one of the wildest stock market battles in recent history. Story 3, Robinhood and the GameStop controversy. It started as a joke. A bunch of Reddit users, posting memes, cracking jokes, talking about stocks like they were sports teams. But then, the joke got real, and Wall Street didn't laugh. This is the story of how regular people tried to beat the system, and how Robinhood, the app made for the people, pulled the plug when things got too real. Let's rewind to early 2021. A stock called GameStop, yeah, the same one that sells video games in the mall, was trading at around $17 a share. It wasn't exactly booming. In fact, most big investors thought it was on its last legs.
Hedge funds were shorting it hard, basically betting that the stock would go down and that they'd profit when it did. But on Reddit, in a subreddit called Wall Street Bets, some users noticed something. GameStop was heavily shorted, so much that if people started buying and held onto it, it could trigger a short squeeze, meaning those hedge funds would be forced to buy back the stock
to cover their positions, which would drive the price up even more. So that's exactly what they did. People bought in, they rallied, they posted screenshots of their trades. Hold the line, they said. Some even put in their life savings. And it worked. GameStop's price shot through the roof from $20 to $100 to $300. At one point, it hit $483 a share. Billions were wiped from hedge fund portfolios. One of the biggest, Melvin Capital, needed a bailout. They got a $2.75 billion lifeline from other firms, including Citadel. Now here's where it gets messy. Most of the retail investors, the everyday people, were using an app called Robinhood. It had a clean design, no commission fees, and it felt like a game. Literally. The app had confetti animations when you made a trade. It felt fun, easy, like anyone could be a Wall Street pro. But on January 28, 2021, Robinhood did something no one expected. They stopped users from buying GameStop stock. You could sell, but you couldn't buy. Other popular meme stocks like AMC and Nokia, same thing. That move sent GameStop's price tumbling. And users? They were furious. Why would a democratized trading platform suddenly block the very people it claimed to empower? Robinhood said it was a liquidity issue, that they didn't have enough cash on hand to meet the deposit requirements from clearinghouses because of the market volatility. In plain terms, too many people were trading too fast, and Robinhood couldn't cover the risk. But critics weren't buying that explanation. They pointed out that Citadel, the firm that bailed out Melvin Capital, also happened to be Robinhood's biggest customer. They paid for Robinhood's order flow. In other words, Robinhood sends trade orders to Citadel to execute. That raised questions. Was Robinhood protecting its users or protecting hedge funds? The backlash was huge. Politicians from both parties started asking questions. Congress held hearings. Robinhood CEO Vlad Tenev was grilled about what really happened and why users were blocked from buying. He denied any shady deals, but the damage was done. People felt betrayed. Lawsuits were filed. Trust in Robinhood took a major hit. So what do we take from this? Well, maybe Wall Street isn't as untouchable as it used to be, but it's also clear that even in a digital age, the systems aren't built to favor the little guy. What happened with GameStop wasn't just about a stock, it was about power, access, and what it really means to be free in the market. Because when regular people start to win, suddenly the rules start changing. Next, we'll look at a case that shook the financial world from the inside. The fall of MF Global and how $1.6 billion of customer money simply vanished. Story 4. MF Global. Vanished billions. Imagine waking up one morning and finding out that $1.6 billion, money that was supposed to be safe, money that didn't even belong to the company, was just gone. No robbery, no hacking, just vanished. That's exactly what happened with MF Global, one of the biggest financial collapses since the 2008 crisis. And the most shocking part, no one really paid for it. Let's go back to 2010. MF Global was a major brokerage firm. It handled trades for big clients, hedge funds, banks, companies. It wasn't a household name, but inside finance, it was a serious player. Then came John Corzine, former Goldman Sachs CEO, former U.S. Senator, former governor of New Jersey. Corzine had big credentials and even bigger ambitions. When he took over MF Global as CEO in 2010, he wanted to transform it from a middle-of-the-road broker into a major investment powerhouse, kind of like a mini Goldman Sachs. And to do that, he made a bet. Corzine started heavily investing in European government bonds. Countries like Italy, Spain, and Portugal, which were all going through a major debt crisis at the time. The logic? These bonds were risky, sure, but if the European Union bailed those countries out, the bonds would hold up, and MF Global would make a lot of money. He used a strategy called repurchase agreements with customer collateral. Basically, MF Global was borrowing money using customer assets as part of the backing, and then using that money to bet on European debt. That's where things cross the line. Here's the problem. Customer funds are supposed to be sacred. They're not the company's to use, they're just held in trust until trades are made. But as MF Global kept doubling down on risky bets, the lines started to blur. By late 2011, rumors started swirling that the company was in trouble. Credit agencies downgraded MF Global's rating. Investors panicked. Clients began pulling out their money, and that's when the truth came out. When the books were checked, around $1.6 billion in customer money couldn't be accounted for. It was gone, moved around, used in ways it never should have been. Some of it had been transferred to cover margin calls, some moved to counterparties, but it all pointed to the same thing. MF Global had commingled customer funds with its own trading accounts, a massive violation of financial rules. On October 31, 2011, MF Global filed for bankruptcy. The eighth largest in U.S. history at the time. Thousands of customers were left stunned. Farmers, ranchers, traders, people who used MF Global to hedge their risks were suddenly locked out of their accounts. Investigations followed. Congress held hearings. Corzine testified, but claimed he didn't know where the money went. It was a mess. But here's the twist. No one went to jail. Not Corzine, not the CFO, not anyone else at the top. The company paid civil fines. Some executives were barred from the industry. Eventually, most of the missing money was recovered and returned to customers. But still, for a case that big with that much money mishandled, no criminal charges were ever filed. So what does this tell us? That even after the 2008 crash, even with all the talk of reform and accountability, the same patterns kept playing out. Risky bets, customer money in the crossfire, and when it all falls apart, a lot of finger-pointing, but not much justice. Story 5. Archegos Capital Management. The $20 billion domino effect. You've probably never heard of Archegos Capital Management. That's because it wasn't a big-name hedge fund, it wasn't publicly traded, it didn't manage money for clients, it was a family office, basically an investment firm that handles the wealth of just one ultra-rich person. In this case, that person was Bill Hwang. And even though he kept a low profile, Hwang's trades quietly ran into the tens of billions of dollars. So big, they eventually took down some of Wall Street's largest banks. Let's back up. Bill Hwang wasn't new to the game. He used to run a hedge fund called Tiger Asia, which was backed by Julian Robertson's Tiger Management. But in 2012, Tiger Asia was shut down after Hwang pleaded guilty to insider trading and wire fraud. He was banned from trading in Hong Kong and had to pay a hefty fine. Still, in the US, he was allowed to keep managing his own money. So he started Archegos Capital Management. And that's where things started to get interesting. Archegos didn't take outside investors, so it wasn't subject to the same regulations as hedge funds. That meant less scrutiny, fewer disclosures, and a lot more room to take big risks in the shadows. And that's exactly what Hwang did. He used something called total return swaps, a financial instrument that lets you bet on a stock without owning it directly. It also lets you stay anonymous. So while it looked like the banks owned the shares, it was really Hwang who held the risk behind the scenes, and he wasn't making small moves. He built huge positions in companies like Viacom-CBS, Discovery, Tencent, and others, sometimes owning over 10% of a company's stock without ever appearing on any public shareholder list. He did this with leverage, borrowing billions from banks like Credit Suisse, Nomura, Goldman Sachs, and Morgan Stanley. They kept lending,
because as long as stock prices kept rising, everyone was making money. But then came the trigger. In March 2021, Viacom-CBS announced a new stock offering. The market didn't like it. The stock dropped. And because Huang was so highly leveraged,
that single move blew a hole in Archegos' portfolio. When the banks saw what was happening, they scrambled to unwind the trades. Goldman and Morgan Stanley moved fast, selling off massive blocks of stock to limit their losses. Others, like Credit Suisse and Nomura, moved slower, and they got crushed. Credit Suisse alone lost $5.5 billion. Nomura lost over $2 billion. In total, banks lost more than $10 billion. Markets lost another $10 billion in value. And Archegos completely wiped out. The fallout was massive. People started asking, how could one firm, one man, create this much damage without anyone knowing? Turns out, family offices don't have to disclose their positions like hedge funds do. There's no public reporting, no transparency, no risk checks outside the banks lending them money. The SEC, Congress, and global regulators all took notice. They launched reviews, held hearings, and talked about closing the loopholes. But again, like in so many other stories, no criminal charges were filed immediately, at least not yet. What the Archegos collapse showed us is that opacity plus leverage is a dangerous mix. And when things go wrong, it's not just the risk taker who suffers. After walking through these stories from Jordan Belfort as high-pressure penny stock sales to Archegos Capital as hidden leverage, one thing becomes clear. Fraud doesn't always start with obvious villains. Sometimes it starts with a dream, an ego, or the desire to keep winning. And whether it's a startup faking videos, a family office hiding trades, or a trading app playing both sides, the results are the same. People get hurt, markets lose trust, and institutions scramble to clean up the mess. These stories aren't just about big names or billion-dollar losses. They're reminders that the financial system runs on trust. And when that trust is abused, the damage can spread far beyond the boardrooms where the lies began. 10 lessons learned from these stories. 1. Transparency isn't optional. It's essential. In almost every case, Stratton Oakmont, Nikola, Archegos, the fraud thrived in secrecy. Whether it was fake demos or hidden trades, the lack of transparency created the perfect cover for unethical behavior. Lesson: investors, regulators, and the public need clear, honest information to make good decisions. When that's missing, risk explodes. 2. Greed is a powerful, dangerous motivator. Jordan Belfort wanted more money, more luxury, more control. Bill Huang wanted bigger bets and more influence over markets.
Lesson: greed doesn't just cloud judgment, it invites shortcuts. And in finance, shortcuts can lead straight to disaster. 3. Regulation gaps create loopholes and risk. Family offices like Archegos operate in a gray area. Apps like Robinhood weren't fully prepared to be financial gatekeepers. Lesson: as finance evolves, regulation needs to evolve with it.
Loopholes don't just let bad actors slip through, they can crash the whole system. 4. Financial education matters more than ever. The GameStop episode showed how little many retail investors understood about risk, leverage, or market dynamics. Lesson: democratizing access to markets isn't enough. People also need the tools and knowledge to protect themselves from manipulation. 5. Innovation can be used to mask deception. Nikola talked big about transforming transport. Theranos, if added later, promised to change medicine, but neither delivered. Lesson: just because someone uses tech buzzwords or gets big-name investors doesn't mean their product works. Ask questions. Follow the facts. 6. Trust, but verify. Many of these frauds worked because people trusted too easily. Banks trusted Archegos, investors trusted Nikola, users trusted Robinhood. Lesson: in finance, skepticism isn't cynicism, it's due diligence. 7. Retail investors often take the biggest hit. Whether it was Stratton Oakmont's cold calls or Robinhood's freeze-on trades, the little guys often ended up losing the most. Lesson: the system still tilts toward institutional power. Everyday investors need more protection, not less. 8. Accountability is often slow and uneven. Jordan Belfort went to jail. Trevor Milton is facing trial, but many others walked away with fines or nothing at all. Lesson: Enforcement can be inconsistent. Real reform needs more than headlines. It needs action and consequences.
9. A lavish lifestyle can be a red flag. Yachts, mansions, private jets, all of them showed up in these stories, often paid for not by profit but by deception. Lesson: flash doesn't equal success. It can also signal desperation or an image built to distract from the truth. 10. If it sounds too good to be true, it probably is.
Whether it's unbelievable returns, game-changing tech, or risk-free strategies, financial fraud often hides behind big promises. Lesson: be curious, be cautious. Always ask, what aren't they telling me? Investment will always have risk. That's part of the game. But fraud? Fraud is a choice. And every time someone chooses it, they gamble with other people's futures. The more we understand how these scams work, the better we can protect ourselves and hopefully build a system that works for everyone, not just the insiders.